Hello and welcome to our monthly portfolio update. I'm Chris Payton, Chief Investment Officer here at La Trobe Financial. Last month, I confirmed an increase in our distribution rates which took effect from the 1st of June. With our excess cash reserves having been progressively reinvested, the asset mix in our portfolios normalising and market interest rates increasing, we are pleased to be bringing you more good news with our crediting rates on each of our portfolio accounts to increase for the second month running. This month, we are able to introduce the following increases early, that is, from the 29th of June, with the increases all in excess of the recent movement in the official cash rate. The Classic Notice account will increase by 75 basis points to 2% per annum. The 90-day Notice account will increase by 60 basis points to 2.3% per annum. The 6-month Notice account will increase by 60 basis points to 2.35% per annum. The 12-month term account will increase by 60 basis points to 4.3% per annum. The 2-year account will increase by 60 basis points to 4.4% per annum, and the 4-year account will increase by 60 basis points to 5.5% per annum. All of the rates I've just mentioned are variable and determined monthly. We, as always, remain cautious in our approach to managing our portfolios and are attuned to the prevailing economic headwinds and tailwinds impacting the economy at any one time. Right now, investors may ask how we position our portfolios to withstand the economic cycle, including periods of economic volatility like we are seeing right now. As we cover in our economic update, we are in an environment of declining property prices, increasing inflation and rising interest rates. Let's start with volatility in property prices and how we seek to manage this through diversification. Often considered the one free lunch in investing, we have long said that a highly diversified portfolio of granular, vanilla assets gives the best chance for success across all economic cycles. And as we approach our 70th birthday, we have a long history of success managing this strategy through a wide range of market events, including the GFC and more recently the COVID-19 pandemic. Across our portfolio accounts, we maintain a bias towards residential assets, which have historically been the most reliable performer of all real estate assets. We supplement those residential assets with strategic exposures to commercial, light industrial, development, rural and vacant land assets, maintaining a highly diversified portfolio of assets by sector. Our diversification and the granular nature of our portfolios is perhaps best demonstrated by the fact that our top 10 biggest mortgage assets comprise just 2.3% of our portfolio. This, of course, ensures that no one loan will drive the performance of our portfolios. In fact, with 12,165 individual mortgage assets, we maintain the most diversified fund in our sector. We also ensure that our portfolios are diversified by jurisdiction, with our experience as a national asset manager allowing us to generate and manage assets which broadly follow the Australian population. By maintaining appropriate state-based allocations, our portfolios are never overweight in exposures to any one geography. And let's not forget the all-important conservatism embedded within our portfolio settings, which aims to protect investors against periods of downturn in the economy and the property market more broadly. Take, for example, our 12-month term account, which will only invest in a mortgage asset with a maximum loan-to-property value ratio of 75%. The average across the credit fund, including the 12-month term account, is actually much closer to 65%, providing investors in our portfolio accounts with significant downside protection, and is part of the reason why none of these investors have experienced a loss of capital ever. Our ability to perform during periods of increasing inflation and borrower interest rates are best looked at through the lens of our target borrowers and our credit approval process. We target high-quality borrowers looking outside of the scope of the Big Four banking environment. Considered complex prime, these are bank-adjacent borrowers who represent strong credit prospects, but may require a hands-on approach to their loan application. This is what we've been doing for 70 years, with every single application being reviewed by at least 3 separate, fully trained members of our 200-strong credit team prior to the loan being approved. Building portfolios centred around these high-quality borrowers protects against inflation and rising interest rates, as they have demonstrated their ability to perform across the cycle. Indeed, if we were to start a period of economic stress, we are starting at the best possible place. Starting with a look at borrowers under residual pandemic hardship provisions, and I am pleased to say that not a single borrower remains in this category. Borrower arrears, likewise, are exceptionally low. In fact, they are at their lowest ever level in aggregate across the credit funds. Our 12-month term account sits even lower, an amazingly strong position to be in after a 2-year pandemic event and as we enter a new period of increased borrower rates. At all points across the cycle, arrears observations of the 12-month term account have stayed within a tightly controlled band and in line with our expectations, irrespective of the inflationary or macroeconomic environment of today. In fact, over the last decade, there has been no correlation between inflation or interest rates against the annualised arrears of our 12-month term account, which were minus 0.27% and minus 0.44% respectively. To summarise, the La Trobe Australian Credit Fund is structured to offer inflation-responsive variable returns and downside protections across all points of the economic cycle. Our portfolios have been built to provide resilience at all points of that economic cycle, including periods of high inflation or falling property prices. We never lose sight of our role as careful stewards of your capital. Thank you for watching. I look forward to continuing to bring you these updates each month. If you have any queries, please contact our asset management team on 1800 818 818. Thank you.